Now, we have seen and have been discussing the wild price action that we've seen in names like GameStop, AMC, just to name a few, because there's many of them. Now, you may have missed out on some of that action. Maybe you want to be a part of it, but you got to be careful. That's why we bring in a pro, Gina Bolvin, President, Bolvin Wealth Management Group. So talk about opportunity costs, because wow, wasn't it fun to take a look at some of these high flyers? At one point, I took a look, Gina, and I saw some of these names all up more than 200% each, which was felt so crazy. Let me just tell you the names of the ones that I saw that I just couldn't believe when I saw. GameStop was up 130, AMC 215, Cost Corporation 225, Express 248. Percentage, I mean, 250% in one day. Oh my goodness, opportunity cost, tell us.
What about Bitcoin?
Yeah, that's the other thing. I mean, it's been a big move. It went from what, 42,000 to 30,000. It's you got to be ready.
Yeah, well, you know, I don't think that investors should really be kicking themselves if they're not invested in some of these high flyers, Nicole. You know, I think opportunity cost, it's also not even limited to high-flying individual stocks, right? I think individual investors and retail investors are more impacted by not owning some of the more obvious investments. So, you know, let's take a look at small cap stocks. Small cap stocks in the Russell 2000 had a banner year last year, and the month of November alone was up 30%. Talk about a blowout. You know, so I think that that's something that retail investors should think about and should look at. But hindsight investing, you know, it really can cause you to make some bad decisions, right? It causes you to chase the market, chase performance, market timing, and that's what gives you that FOMO, that fear of missing out. So I think you're right. You got to be careful.
Yeah, you know what? And chase is such a, it just sort of gives you the heebie-jeebies. You can't chase the market, right? You need to be very methodical. And the fear of missing out is one thing, and saying, hey, you know what? I feel I've missed out and I want to make some great decisions. How do you avoid saying, okay, I'm not going to worry about some of these missed opportunities, but I want to get in? That's a different game, right? You want to get in. There are opportunities going forward. Doesn't mean you should put it all in today and hope to get out tomorrow. That's craziness.
I think you first want to figure out and take a gut check, right? Are you a trader, right? Are you swinging for the fences? Are you making really big bets? Are you going to live by the sword and die by the sword? Or really, are you a long-term investor? And that's what my clients are, and that's what we help our clients do, is become a long-term investor. And, you know, some of the strategies we have in place right now, I can share with you, is to really have I'm going to dare to be dull, a diversified portfolio, right? A diversified portfolio doesn't just mean owning stocks and owning bonds. You also want to own different company sizes. That would be large, small cap, mid cap, even some micro cap. And then you want to diversify amongst different types of style. And this is really important, because if you were invested in just value and dividend paying stocks last year, you really didn't participate that much. If you were in energy or financials, and we find that when growth zigs, value zags, and right now people are talking about, is the rotation going to happen into some of these recovery stocks? And that's why I think it's important that you would own a little bit of both, and you want to spread your risk out, because you're always going to participate in whatever the hot dot is.
What do you recommend at this point? I mean, how do you spread out so that this way you don't have a lot of risk? You have only some, I guess, if you're willing to have a little risk tolerance. So what are some best bets or ways, advice that you give to folks when they want to invest and put some money to work? Do you say buy, you know, an index? What do you tell them?
Well, I do think that we still like technology. I sound like a broken record, but
Yeah.
we still like technology stocks. It's hard. Apple just came out with their earnings, blockbuster earnings. Microsoft last
Sure.
night. There's a reason, some of these blue chip stocks are doing really well. As you want to follow profits, you want to follow earnings. It's never bad when you're following solid companies and fundamentals. So we do have a tilt towards large cap growth and large cap technology stocks. Within the technology sector, we really like semiconductors. One of your guests right on before me mentioned the digital pay. We still like that area. We like anything to do with the cloud, which is why Microsoft has done so well and their earnings were so good last night. In terms of small cap stocks, the Russell 2000 was down a couple of percentage points today. We think some of this volatility may be a good catalyst to diversify your portfolio. And also, we think it's a way to rebalance your portfolio and stay disciplined in terms of shaving some profits off the winners and adding into some of the asset classes maybe that haven't moved yet, and that would be more of the recovery trade.
Gina, always great to chat with you. And you're right. I mean, we just talked about Apple, blockbuster record numbers, record revenues here. So, and the stock is moving to new highs in the after hours. So it's certainly a name to watch tomorrow and going forward. It's great to chat with you, Gina, always. And I respect that you still like tech. I mean, it's done very well over the last decade. Gina Bolvin, President, Bolvin Wealth Management Group. Thank you.